Alright, Nick Fenton here, founder of TickerTank.com. We're back for part 2 of our short Strangles strategy criteria series. This one is a simple topic, but it's my preferred time criteria. Now, I say my preferred time criteria because when I do these series, it's based on my time-tested methods approach to these specific strategies, in this case, short Strangles. So, take it for what it's worth. You don't have to do exactly what I say or do exactly what I do, but you're at least going to get some good information here, and it's going to hopefully open your eyes to the power of this strategy. So I look at this as a duration-based strategy, and I'll say it again, short Strangles is my absolute favorite option strategy available. So it's a duration-based strategy, duration being time. I look for theta decay as my primary objective, which is just time ticking away, time premium ticking away out of those options. And I benefit from that time decay taking place. I also look for volatility premium to reduce during the holding period, which is why I try to sell when the IV percentile is at extreme highs. So above 50, the closer to 100, the better. But anything above 50 is eligible in my book. Now my time criteria is 40 to 70 days is an eligible time criteria. My sweet spot is 50 to 65 days. So I prefer something 50 to 65 days from expiration, but anything 40 to 70 days is eligible for a short strangle. Anything below 40 I generally stay away from. Just not enough theta decay potential there. And anything above 70, you're just kind of getting into the situation where just a little bit too much duration in that specific trade. I've noticed on the bell curve of theta decay potential that 50 to 65 day period really seems to be like the sweet spot where you maximize your theta decay potential. And so I always keep that in mind, and I look for stuff between 50 and 65 days. So here, the way to determine how much time is left, in case you don't know, we're looking at the trade screen in Thinkorswim, and here the February options would be my choice. Reason being, it shows Feb 14 here, and it has 59, and that's the amount of days left until expiration. And so basically, it's perfect for my criteria. It's right there in the sweet spot of the sweet spot, if you will. So remember I said 50 to 65 days is my sweet spot. 59 days is great. That's perfect. The next thing I would look at is part of the core framework. Are the options liquid? And in UNG, the options are most certainly liquid. If you go to the current price, or the last price, 21.78, so the closest to the money strike would be the 22 strike. If you look at the 22s, you can see 149, 157 bid ask on the put side. So you're looking at 8-cent bid ask spread, and there wasn't a whole lot of volume and open interest, but today it was a half day. It's Christmas Eve 2013, by the way. So these volume and open interest numbers aren't really good to look at from a liquidity perspective because there wasn't a whole lot of activity in the market today. It closed at 1 p.m. Eastern time. But these bid-ask spreads are fine. Anything 10 cents or below, I'm good with. So the moral of this part of the series is that time criteria for me very important. 40 to 70 days eligible time criteria. 50 to 65 the absolute sweet spot. Would I prefer to trade in that 50 to 65 range? So 59 Feb 14s right now with 59 days till expiration are absolutely the perfect scenario for selling strangles. So in part 3, I'm going to talk about how to pick the strikes that you want to sell. So now we've talked about the core framework a little bit. We've talked about the time criteria. Time to get into how to pick the strikes. So I'll see you in part 3.